Hello and very good morning to all our dear students. I warmly welcome you back to our Board of Studies classes conducted early in the morning. So it's been the last day of the year. I know it's just number because the dates will reshuffle towards the next year. Everything in life will remain the same, obviously, but definitely one psychological thing that we have completed 1 year. We want to see what was the progress that we made in this particular year and how we can improvise in the next year. So this year, I hope and I wish, pray for you that you complete your this very prestigious degree for which you are doing a very hard work and putting a lot of efforts. So I warmly welcome everyone for this last class for this year and for this chapter as well. So now coming to the studies, we will be concluding this chapter today, that is the International Financial Management. I think we have done a good set of questions in the last class, wherein I taught you the concepts of the home currency and the foreign currency approach. I hope you remember that. I'll just give you, let's say, a recap again, not a problem. What is also to be understood as far as this chapter is concerned is that the concept of adjusted net present value. Sir, what is that? Yeah, I'll come to that because today I'll be discussing. If I say from the last few attempts, okay, say taken from 2019 till today, adjusted NPV has become an important aspect. Okay, when I say important, I'm not an examination setter. Okay, neither anyone from the Board of Studies is an examination setter, but we know that what basically is going in the examiner's mind. So you should be thorough as far as this chapter is concerned. You should be knowing that you should know what are the two approaches as far as the NPV is concerned, and also the concept of adjusted NPV as far as this international budgeting concept is concerned. Okay, you can see this one. Okay, so one is two approaches. Okay, and second one is adjusted NPV. Okay, adjusted NPV. Adjusted NPV. So today we'll be discussing this as well. And then you come as the international source of finance. This is more theoretical. There are questions as far as the practical are concerned, which consist of FCCB, okay, ADR, GDR. You have a question of GDR in your study material and in the assignment as well, which is question number 2, which we'll be covering up today for sure, and some other Euro bonds as well. Okay, other bonds, Euro bonds, and etc. Okay. International financial working capital management is again little bit what you have studied in CA Inter, but extension of little more that. So you'll be covering up the concept of netting. The concept of netting is same. You would have done it in your Forex chapter. Okay. So this will come again in this chapter and some more things that we'll be discussing now. Okay. So keep this slide preserved till your exams so that it becomes beneficial and helpful for you. Okay. If you have any doubts, let me know. And it's always good to see you, Akash. A very good morning. I hope you are doing absolutely great. I wish for your well-being and for your entire family. Thank you for coming. And now we can start with the concepts. Okay. So let me just remove all this and then we can proceed further. Okay. I'll give you a recap as to what we have done till date. Okay. So beta, we are following the assignment. So we have to calculate. The calculation of NPV is the most important thing as far as the concept we studied in the last attempt. Last time means last class, not attempt, last class that happened on the last Wednesday, 27th. So there we had discussed that there are two approaches when you have to calculate the NPV. One is called as the home currency approach, and one is called as the foreign currency approach. Okay. So what all matters in the exam is nothing but your beta presentation. Okay. What matters is the presentation, that how you are doing the presentation. If you have forgotten, you are requested to go back to the class number 1 of this chapter so that you can recapitalize. But I have a gut feeling that you know what's the presentation. What's more important in this, that the presentation matters because the NPV will be same in both cases. Means as far as the presentation is concerned. You remember the question number 6, if I remember correctly, the question number 6 that we did, we had already proved this, that the two things where we are able to get the same NPV, approximately some difference. If you remember, we did this concept of the first one we did for this home currency approach, if you remember, and the I think the answer was 332,075. Okay, and here 332 300 or 200 was there, I think. So not major difference was there, all because of some approximation. So NPV in both the case will come same. Okay, beta, same, clear. Now we are moving to the assignment. We have one more question. I'll give you to study that. Okay, just 1 minute. Let me share the assignment with you. Yes, I hope that is visible to you. So beta, I think we have done question number 1. Okay, question number 2 is pending. Question number 3 is we did last time. Question number 4 also we did last time. Now we have to start with question number 5. 6 we've already done, but at least we'll do 5 first, and followed by the concept of adjusted net present value. After this question, not now, after this question. Okay. So I'm sure the assignment was in possession with you earlier only before the class. So you can study this for a minute. Okay. Then we can start with the concept. Okay. I don't know how many of you face this problem. Those who wear specs, those non-clarity is a very big problem. Okay, beta, chalo, let's start. A multinational company is planning to set up a subsidiary in India. It's a good question, huh? Very nicely prepared. Just 1 second. Yes, okay. I get the full screen access now. Okay. It means a company was there, okay, and they were exporting it earlier. Now they want to create a subsidiary. Okay, a multinational is planning to set up a subsidiary in India. Okay, I hope we have not done this one. Okay, not this one. Yeah, I hope we have not done this one, right? Yeah, we have not done this one. Okay, so a multinational is planning to set up a subsidiary in India, wherein the growing demand for a product and competition from the other MNCs. The initial cost, which is of plant and machinery, is to be estimated at $500 million. So a company is in US, okay, and they want to set up a company in India, okay, US. So they will be paying about roughly 500 millions as their working capital, and the no, working capital is a little different. The project cost, means buying of the plant and machinery, will be for 500 millions, and the working capital requirement will be for 50 millions. The company follows a straight line method of the depreciation. Presently, the company is exporting 2 million units at a unit price of 80, having the variable cost as 40. We have not done this question, but stay tuned, because I will be giving you a very good information about this question. Sir, what? But just wait for some time, you will get that information, what I want to tell you. First, read this question, then I'll be sharing you a very astonishing, what do you call, fact with you, okay? So the chief financial officer, okay, is estimating the following operating cost and other costs in respect to the proposed project. The variable cost will be $20 per unit of production. Additional fixed cost will be 30 millions, and a project share of the allocated fixed cost to be 3 millions per unit based on the principle of ability to share. So this is little technical, okay? It says the additional fixed cost will be 30 millions, but they are allocating the project cost to be only 3 millions based on the principle of ability to share. So as you know that how much fixed cost are we supposed to take it from here? Okay, 30 or 3. Let me know your answers just in case you have assessed what is the requirement of this. Okay, this is clear. Variable cost is easy, $20 per unit of production. Now, how much in totality we have to take the fixed cost will be 30 millions per annum, or it will be 3 millions per annum. Okay. Production capacity of the proposed project in India will be for 5 millions. The expected useful life of the proposed plant in 5 years with no salvage value. Okay, beta. So 500 millions is what your total investment would be in this company as far as the plant and machinery is concerned, and their life will be for 5 years. Existing working capital investment for the production and sale of 2 million units through the export was rupees 15 million. Export of the product in the coming year will decrease to, okay, to, not by, to, okay, to and by, you understand? So now they were exporting 2 millions, now they'll be exporting only 1.5 million. So there will be a reduction of 0.5 million units. Clear? In case the company does not open subsidiary in India, in the view of presence of the competing MNC that are in the process of setting up their subsidiary in India, the tax rate is 35% and the required rate of return is 12%. Assume there is no variation in the exchange rate of the two currencies. All the profits will be repatriated as there will be no withholding tax. In the previous question that we did, question number 4, there was a withholding tax. If you remember that software wala question. So here there is no withholding tax. You are supposed to calculate the NP. Okay, beta. Now the thing that you must all be waiting for, the one. Okay, yeah, no other thing which is left over here. So one of the astonishing thing, beta, this exact question came in November 2019 new course. No, I'm not saying that this will come again in 21. I'm not predicting that. I'm just telling you what is basically my logic to explain you. See, beta, this question is from your study material. There was a book called as Practice Manual, which was there in the old course. Very beautifully drafted. I mean, it was really a diamond. Okay, it was really a diamond. So from that, few question has been taken in your new course as well. And a problem is a lot of time that student doesn't refer to the study material. They find sometimes that that is not very sufficient as far as this question is concerned, or some of the other. The main thing you have to do is, beta, that please refer to the study material. Do not ignore it. Okay. The same question came in the exam, and a lot of students could not solve that. This is what not I am saying. This is what was the examiner's comment. If you go back to the after the answers are published by the ICI, you can see there are some examiner's comments as well. So they were not very nicely done as far as this question is concerned. Students got confused in a lot of areas, but to be very honest, it has a very similar data what is there in your study material. Okay, so that's it. No more lectures. Just make sure that you are referring your study material, whether it's for theory or whether it's for practical things. Earlier, when there was an old course, I don't know if you had seen the old course or not. I would like to share one thing, that a lot of people used to leave theory. Yes, in SFM, they used to leave the theory altogether. Why? Because the paper setup was such that the last question, okay, I mean, the question paper ke andar, the last question used to be all theory questions. Okay, so 16 mark question used to be there. 5 questions, you have to attempt 4 out of them. And student used to think that I would just focus only on practical. So that part was missing. That was the wrong approach, I would really say, leaving theory. But now, since old course will no more be there, you have to focus that you don't leave any theory, because now theory comes in your compulsory questions as well as your main question that you have to attempt. So kindly refer to the study material so that you can complete it. Okay. Just last words and then we can start this question. Okay, beta? Okay. Yeah. So can we start now? Okay, thank you, Akash, for your answer. I will just come back to that. If that answer was correct or not, I will let you know. Don't worry about that. Okay. So, solution number 5. Okay. The very first thing is that we requires the calculation of the cash outflows. Okay. Calculation of cash outflows. Okay. So what is the investment in plant and machinery? 500 millions. What is the working capital that is required? That is 50 millions. Okay, these are all in $1 million. Okay, beta, 50. Achha, one more thing. They said about something of the release as well. Release means something will be released. You can see on point number 5. Can you see, everyone? Point number 5. Existing working capital for the production of for the production and sale of 2 million units was 15 million. So I think this will be released since we are putting in more amount of money. Okay, so net amount will be for 35 only. Okay, so you will have the release of working capital amounting to 15 lakhs. Okay, so this comes out to be how much? Directly 535. Okay, that part is over. The cash outflow part is over. Now we have to calculate the cash inflows post taxes. Okay, cash flows, because tax rates are given to you, and you have to also see what is the opportunity cost. Okay, as far as this project is concerned, and the net amount. All these things will be doing. Okay, so 535. I hope you will remember, and you must have written it in your notebooks. Okay, I will just rub that. Okay, now comes the point number 2, calculation of cash inflows bracket post taxes from setting up the subsidiary in India. Okay. In India. Okay, ji. So what will be the sales revenue, beta? Can you identify that? How much has he said? He said 5 millions. Okay, multiply by 80 will be the revenue. You want to see? I'll show you. Okay, so it's mentioning you over here that it will be a 80 rupees unit. Okay, and you will be selling how much? Presently it is exporting this much. I just saw that. Yeah. Okay, production capacity. So we are assuming that how much we are producing, we will be fulfilling that demand overall. Okay, clear? So 5 million into 40 will be the revenue, and the variable cost will be 40. This is clear. Now comes the, oh, sorry. This is the existing one. This is the new variable cost one. Okay, this is in India. Okay. Now comes the additional fixed cost. So they are saying that allocated fixed cost is 3 millions. Okay. See, Teju, I'm replying to you because since you have given the answer. When you do a new project, okay, when you do a new project overall, which is for wholly for this purpose, there is no other operation that will be going on. Then you take the total fixed cost. Sir, samajh nahi aaya, na? This must be a thing. Okay. See, I am saying you that you are in USA. Clear? Yes, sir. You have to set up a company in India. Clear? Yes. How many projects are you going? Are you gonna be doing that? Sir, only one project, hai na? Only one project, and you will be producing 5 million units. Okay. Allocation is done when you are doing multiple projects in a particular country. Okay, so let's say you are making calculators also, you're making tablets also, you're making laptops also. So you allocate that cost in between the products. Okay, I'm sure you must be doing that in SCMP or IFA number 5 and in your CA Inter. You must have seen that if a company is producing various units or various different articles, they are allocating that cost to various things. Okay, those service costing and all those. So since the company is doing only one project, so the entire cost will be coming over here. This 3 million was given to confuse you by the examiner. Okay, I hope that's clear now. Okay, so now let's move to that. So we will be taking this 20 as the variable cost and 30 millions as your fixed cost and the depreciation. Have kya depreciation bhi dekh lein? Should we see the depreciation as well? So beta 500 millions is what the thing is, and you have a life of 5 years. Okay, 5 years with no scrap value. So we can say the depreciation will be 500 divided by 5, that will be 100. Okay, clear? And you will be taking this fixed cost as well, 30, and the variable cost as 20. Okay, your units will remain same, 500 millions, and your tax rate is 35%. Okay, after this is clear, so we can know that what will be the cash flow from setting up the subsidiary in India. All the values now we have. Clear? So revenue will be for 400 millions. This is also in millions dollars. 400, not 500, 400. So 400 millions would have been the cost. Okay. Less the variable cost, 5 millions into 20, which is given to you, less the fixed cost total. Okay, so that will be 100 and 30. Okay, and the depreciation we've already calculated there, 500 divided by 5, that is 100. Okay, clear? So that comes to how much? 230 and I think 170, right? So your EBIT becomes 170. So you can reduce the taxes from here. Okay. $51 will be the tax. Oh, sorry, 35 was there, right? 35. 170 ka 35% will be 59.5. Okay, and 110.5. Okay, so this will be your EAT. So for cash flow, you have to add back the depreciation and amortization. Okay, so you can just add back depreciation, and that will be 100. So this comes out to be 210.5, 210.5. Okay, so this is cash flow after taxes. Okay, clear? So this is one that we have done. What are the 2 steps that we have done? Number 1, we have calculated the cash outflow. Okay, wherein we had calculated the total plant and machinery cost 500 millions, variable working capital for 50 millions, and release of the working capital as 35. So 535 was the amount. This is the cash flow after taxes. Okay, now we'll see that what is the cash generation via export. Sir, what? Keep this figure intact. Let me take you back to the assignment, then you will understand what is the basically motive of discussing that. Just 1 second. Yeah. Okay. Now we have to see what is the opportunity cost we have. Sir, what is an opportunity cost here? I'll take. See, currently, what are you exporting? Sir, we are exporting presently it is saying as 2 million unit per every year. Okay, at a unit price of 80 with a variable cost of 40. This is clear. Okay, it says if you will start making the product in India, okay, the export will get reduced. You are getting a point? Read again. Currently the product, sir, variable cost is 40. No beta, that is for the new project. Okay, 20 is for the new one, 40 is for the existing one beta. Okay, Harshit ji, clear hai beta? These are the all information which are pertaining to the new project, yahan se lekar yahan tak. Okay, ye. So variable cost will be 20, fixed cost will be 30. Okay, and sales will be 5 million revenue, the sale unit, and the depreciation will be for 5 years for this thing, and working capital detail is given. Okay, beta, clear hai? This 40 I'll be using right now. Just give me 2 minutes. Okay, so now comes is that where was I? Yeah. So company currently what they are selling is they are selling 2 million units, which has a unit price of 80 only, but the variable cost is little higher because in US the cost of raw material is higher. Okay, so it says that is the reason that we are trying to make a substitute in India, because in the coming days, because of the increase in the competition, the export will decrease to 1.5 million. In case the company does not open subsidiary in India, in the view of the presence of the competing MNC that is in the process of setting up the subsidiary in India. So our exports will be less. Okay, so we are saying that we are making a revenue from the new subsidiary as reduced by what is the existing revenue that they are earning from the exports. Okay, that will tell us the net amount from the subsidiaries in India. Did not understand? Wait for a minute. I will explain you again what I'm trying to tell you. Okay, let me take you back. Okay, this figure you have preserved 210.50. Okay, I'm rubbing this. So two figures you must have been preserving. The cash outflow is 535 and the cash outflow after taxes is 210.10. Okay. Okay, now I'm explaining you something through which a lot of students get confused. Okay, now see, why should make a person? Let me make a building. Okay, let me make a building now. Okay, this is the company in US. Okay, now they want to make a subsidiary. So currently what they are doing is they are currently exporting 2 millions, and they are expecting that this would come down to 1.5 billion because of the increase in the demands. Okay, millions. $2 million and 1.5 million. Okay, so they want to make a subsidiary in India. Okay, from the total operations that they will be doing, total cash flow they will be getting after setting company in India is how much? 210.50. This is the figure that we have got. Clear? Now they want to know from you. Now they want to know from you. So now they want to know from you that if this exports get reduced, okay, so what will be the revenue you will get from here? From exports. The step number 3. Step number 1 was calculation of the cash outflow. Step number 2, you have to calculate the what you call as the cash flow after setting the company in India. This is their existing revenues. Okay, their existing revenues. Earlier it was 2 million. Going forward, they will be having 1.5. It says because of the increase in competition. It has nothing to do with the opening of the subsidiary. It says because of the competition, it can come down. So what you will present to the examiner is that after setting company in India, you will be getting a 210 this thing, and your less will be existing revenue. how much will be there, so that you can have the net cash flow after taxes from setting the company in India. You're getting my point? Step number one, cash outflow. Yes, sir, that was clear. Step number two, the cash flow after taxes from the subsidiary in India. Clear? Yes, sir. Step number three is, what is your existing thing is there? Okay, how much you will be earning existingly because of the subsidiary in India, that will serve as your opportunity cost. And if you reduce from there, then you will see what is the net amount that you are getting. Okay, clear? I'll do the third part, which is called as the calculation of existing revenue through exports. Okay, now the units will be from 2 millions to 1.5 millions. Okay, clear? So in that particular case, what you can do is, you will see what is your revenue. Okay, the revenue will be 1.5 millions. Okay, millions. Same, the selling price remains same, 80. And now the cost, which is asked by Mr. Harshit, less the variable cost. So 1.5 millions into 40. Okay, Mr. Harshit. So now you will get the fixed cost is not there. Okay, less fixed cost is not given to you, is nil. Okay, so you will get the EBIT. Okay, how much? I think net will be 40. 1.5 into 80 is, I think, 120, and half of that will be 60, and you will be getting EBIT as 60. You will reduce the taxes at the rate of 35%. I think 28 or something into 35. Okay, 21. 21 will be your taxes, and you will get the 39 cash flow after taxes. Clear? Again, coming to that point, what is this basically calculation is? Okay, what is this calculation? What is this calculation? This calculation is nothing but what you are earning currently. Okay, opportunity cost. Okay, sir, what is an opportunity cost? Better see, I am saying that currently you are earning 20,000. Okay, from your non-CA salary. So let's take an example that post your CA, your salary becomes 1 lakh per month. As reduced by 20,000, 80,000 will be your net income after completing your CA. This is how the calculation we do. Okay, so this is what the concept is, that how much you are earning right now and what is the net amount you will be earning from that new venture that you are thinking, and what will be the net cash flow which are attributable to the exports. I hope this is clear. Okay, so we have this third calculation that we have, so that we can end this question. Okay, in question 4, total terminal value in understand, please explain. Okay, wait, I'll explain that. Okay, that day what happened was, I think I think I had written it wrongly. I'll after doing that question, Harshit, I'll write it again. Don't worry. Okay, I have the question with me, nothing to worry. Okay, beta, so this is clear. Okay, so now this is the third thing that we have to do. Okay, now we will do the. Okay, now what we have, a cash outflow, okay, which is 535 millions. Okay, cash inflow from subsidy in India, 210.50. Okay, and the existing revenue, which is, we just calculated 171.5. Okay, beta? So the net cash flow after taxes from Indian investment will be how much? 10 and 20. Oh, no, it was 39. Sorry. 39, right? So net cash flow is this. Sorry, huh? Now don't get confused. Sort of mistake ho gaya. Already reduced that. This is from the existing revenue. ये कैसे आया था? 80 minus 40 minus 35%. I hope you remember that. Okay. ये यहाँ से आया था. This is from where I got that. So this is your net cash flow after taxes from the Indian investment. This is clear now. So can we do the final NPV calculation? Okay, all the things that we have received. Chalo. So now let's do the final calculations. Okay, so you have years over here 1 to 5. Okay, because you'll be getting the same revenue, that is what it said, and the 5th year. Here. So what is the cash flow after taxes, beta? You just calculated over here, okay, which is 171.50. Okay, and the 5 years, the discount rate is 12%. Generally, these days, the examiners are very nice to us, and he is giving us the total. Okay, although I do not have, so but you have this 12%. Okay, so 1 divided by 1.12. Okay, so grand total becomes 3.604. I hope everybody has got that. Okay, grand total. The present value factor at the rate of 12%. So 3.6048. Okay. And for the 5th year, it is 56.5674. So where should I write that? 674. Okay. 5th year, you will be getting the net working capital released. Working capital release. Okay, clear? So you can get the present value as you can calculate. Okay, so $618.219. Okay, and 35 into 0.5674. Okay, so total you can get 638.078. Okay, as reduced by less cash outflow. Okay, so that was 535, you remember? So you'll get 103.078. Okay, 103.078 will be your net present value. So better, since it is positive, that you will be accepting this. So now you tell me by touching your heart and say, was it tough? No. Okay, it was quite easy, but still a lot of students couldn't do this question. Okay, let me take up a few questions. Sir, why we are taking FICO 30? हाँ, ये मैंने समझाया. I just explained, Harshit, I think. Why we are not taking 30 in the existing and 3 in the proposed? This will be more sensible. I feel as India, we are taking fixed cost in India 30 and existing nil, which is not possible in any case. If not, okay. See, your logic is very nice. Honestly, Harshad, better do just use your CA inter concept very simply. Okay, that when you do the exports, okay, just listen to me. Huh? Just listen to me. You will understand. When you're doing exports, what does exports means? Export means that you are making something and you are sending something. Yes or no? You're making something and you're sending something. Where do you absorb your fixed cost? In your holding company, parent company, your home country? Yes or no? Okay. So fixed cost is of two nature, beta. Fixed cost is of two nature. One is when you are exporting, so you are absorbing all the fixed costs within your own holding, or you can say home country. Okay. So here when the export is going on, there is no fixed cost because all the fixed costs are already absorbed in your main holding company. But when you are setting a new company, okay, say outside India, so there you are keeping some manpower, okay, some electricity, some rent, all these fixed expenditure, postage and telegraph, all those expenditure will be of the fixed nature. That will supposed to happen when you are setting up in a factory in India, or let's say production facility in India. Then these fixed costs will come over. Okay, so I hope the logic is clear now. Just let me know if that is clear. Okay, because in exports we are absorbing all the cost within the US company itself. We are not taking any cost. But there, when we are making a new manufacturing facility, we have to take up that cost. Okay, is it clear now, beta? So this question stands complete. Okay, and I think the previous one, in which I think Harshad was asking that he could not calculate the terminal value, right? Was that the case, beta? Okay, let me just take up that. Where was that question? Okay, is it clear, Harshad? Okay, so let me go to that assignment. Okay, and it was question number, I think, 5 that you're talking about. No, question number 4. Okay, four. Yeah, 4. Okay, so you did not understand the terminal value, right? That was the concept. Is it so? Okay, let me just explain it to you. The terminal value. Okay. XY assume the year 3 nominal cash flows will continue to be earned indefinitely. Okay. Now, but the very first thing is what was, you have to tell me the figure. Okay, so Harshad is agreeing with this last concept. Okay, so Harshad, I'm explaining that the cash flows. Then we are coming to the very important concept of adjusted NPV after this. Okay, so beta, somebody can tell me what was the total cash flow from the two this thing. Nominal हमने calculate किया था ना? We had calculated the nominal values, if you remember that. Okay, so total cash flows. Okay, for India, a student is saying 3328. Okay, negative, na? Negative. This I can do at least. Okay. $246,960. But better that was in rands. You have to convert that. So it was 246,960. Okay, that was in African rands. So you had to convert that. Okay. Thank you, Harshad. Thank you so very much. 9979. Okay. So 19979. Okay. So this is in INR, beta. This is also in INR. This is in African rands. Is it clear? Okay. So when you did the net amount for that 3328. Okay. So you got as 16651. ठीक है बेटा? Okay, this was your total cash flow in the third year, and indefinitely का मतलब होता है that you divide it by your discount rate. Okay, so growth is not there. Okay, so growth is not there. So this was in perpetuity. Okay, this I think you must have done it in your chapter. I think security valuation. Okay, so divide by discount rate. So you were doing 16651 divided by 20%. Okay, so divide by 20%. So that was coming out to be, I think, 83,255. Okay, and therein you further discount it at 20% in the third year. Okay, so 1 divided by 1.2, first year, second year, third year. Okay, so into 578 or 579. So into 83,255. So you are getting this value as, you're getting this value as 48,179.97, or let's say 47,180 also. Okay, let's put it 180 because it becomes easier. 48,180. Okay, is it clear now? Harshad, please confirm this value as well, beta. Okay, and then you added all those other three with 48,180. Still, it came out to be the negative one. Okay, this is also clear, guys. Okay, so shall we move ahead now? Okay, everybody, it is clear? Can I rub this? I hope it was legible. Okay, but if you do the calculation, you can do that. Okay, now we are coming to a very important concept is called as the adjusted NPV. As I've been saying, this is one of the interesting concepts from the examiner's perspective, and they are giving over there. So what does basically adjusted NPV means? I will tell you with that. Okay, just 1 second. Let me open up that screen. Okay, everybody has noted this down. Okay, so since it is positive, you can accept. Okay. Project can be accepted. So this is the first question that we did as far as today's class is concerned, question number 5. Okay, and now you can do that, the next one. Thank you, Harshad. Second, the first concept I taught you was the two approaches, which is the home currency and the foreign currency approach, where you are calculating the NP. Okay, sometimes also the cash flow from both will be there from your existing operations and as well as your foreign operations, so you need to add them. Second thing is called as your adjusted present value. Okay, this is called as APV. This is coming in very recent examinations, so I thought why not to cover it in the class. So basically APV, what is that? Hota kya hai? So APV is used to evaluate foreign projects. So that is why we have not heard about this in our CA Inter. Absolutely. You might not have heard about this in your CA Inter because there were no foreign projects. And you cannot understand a foreign project until you do the Forex. Because if bid and ask rate comes in the examination, okay, then it will be a problem. Till now, whatever questions are there in your study material, that has just one rate, if you remember. So just take an example that the examiner is asking you for a bid ask rates. So which rate is to be taken? That will be a problem. Okay, so you are putting 500 millions from your side. Okay, so you will go to the bank from there and you will sell your currency. The bank will buy the currency. So you have to take the bid rates. This has never come in the exam. You never know. might be the examiner sir or ma'am is also watching my video, so they can get a hint. Okay, so just joking, huh? Don't worry. Those are very high level people, so that's fine. So beta APV is used basically to evaluate the foreign projects. Okay, so since that was not there in your C enter, so nothing there. It basically uses a different discount rate. Okay, APV method uses different discount rate for different segments of total cash flows depending on the degree of certainty attached to each cash flow. Okay, now let me just take your test. Have you studied portfolio management in the classes? Okay, you remember the multi-factor model? Okay, where you are not taking a single beta, you are taking a multiple betas. You remember that? Don't remember? Then start studying. Okay, so as far as this thing is concerned, beta, you are not using a single discount rate. You have to use different discount rate for the different segments which are there. Sir, will there be so many variables just like there were very much of the betas were there? No, beta. ICA has been little okay with that. They will not be giving you so many of these segments. Okay, what you need to do is in your course you have majorly three types of things only. Okay, one is that how do you calculate the APV? I'm giving you the formula. So calculation of APV. Okay, beta, कैसे होगा? You will be reducing the cash outflow. Sir, you have written it pehle. हाँ, I written it pehle. You want, you can write it later also if it confuses you. Nothing to worry. Beta, you have to calculate the present value of the operating cash flows. Okay, yes, sir. Present value of operating cash flows. Okay, okay, sir. So for that, you will be being a other rate, obviously. Okay, okay, sir. Then you will be adding present value of interest tax shield. Sir, 1 minute now. Haan, beta. Sir, this is clear. This we have been doing in C Enter also and till now also. In almost 3.5 hours of session. 3 hours pehle and half an hour today. Sir, this is clear. So now what is this? Please tell us. I don't know. Okay. Abhi, tell me one thing. Yes, sir. When you started C Enter, sir, C Enter ki baat hi mat karo, sir. Just go to CFI. Okay. You know that whenever you calculate the EBIT, yes, sir, you reduce interest on that. Haan, sir, this we have done it in C Enter. That is, I was telling you that you have done this in C Enter. Okay, sir. And then you get EAT, EBT and reduced by tax. Okay, clear? This interest is tax deductible or not? Sir, obviously this is tax deductible. This we have done it in our C Enter. And sometimes you don't like talking about C Enter, but there are some things which has come from C Enter from the past. Okay. So there was a movie called as Blast from the Past. Very nice movie. English Hollywood movie. Okay. So this is your blast from the past that you say EBIT and you reduce the interest and then taxes because interest is tax deductible. This you know? Yes, sir. So how much interest, listen carefully, how much interest is giving you the tax shield? This you have to calculate. Okay. I repeat, how much interest, if you are a debt company, you will pay interest or not? Yes or no? Yes, sir. You will get the tax shield or not? Yes, sir. So in that case, you will be uh, taking the interest, tax shield from the interest. But for that, you have to calculate its present value. 1 divided by, okay, so interest divided by 1 plus IC. Clear or not? Yes, sir. Okay, okay. And sir, what will be the discount rate here? In the examination question, you will get. I'll explain you. Okay, okay. And plus, you have present value of interest subsidiaries. Okay, okay. So that will be how much? That will be given to you, interest subsidy. That is very simple, straightforward. For that also, the rate will be given to you. So you can say the subsidiaries, as for subsidiaries, divided by 1 plus interest of C. Okay, and then you will reduce the cash outflow, and you will see if there is NPV is coming out to be adjusted NPV, matlab coming out to be positive or negative. But any doubts still here? Please tell me. Otherwise, you will be making your own loss by not asking any question. Clear or not, beta? Let me explain you once again. This APV concept was not there in your CA Inter. This concept came in your CA final only. It says that you have to compute the adjusted NPV in the very similar manner you have been doing from your CA Inter. Okay, clear. Only one thing is that if the question gives you a debt, that means you are taking a debt, some interest is there. And obviously the examiner will give you if he or she wants you to calculate the adjusted NPV. Okay, so he will give you, the examiner will give you. So in that case, you have to compute the tax shield that you get on paying the interest. And if there is any interest subsidy, means the government is giving you a little subsidy on that, then you will be doing that, taking that impact, and you'll get the present value. You total all of them, and then you minus the cash outflow. You will calculate the NPV. Even if you have understood 30% of this question, this concept, you will get the full clarity from a full-fledged question. Okay, is it clear? Should I show you the assignment, next question, so that you can understand this thing? Yes? Chalo. Question number 7. Okay. Although it's an RTP question, as you know that the ICA is making a tremendous effort to make some RTPs every attempt. Okay, and they give you. So this question I've taken from the RTP from a very recent attempt, I think 18 or 19, I don't remember exactly, but it's a good question. And after this, in 2019 only, you got a question on the adjusted NPV, which was again, a lot of students made a mistake in the exam, could not. But I know you are in a situation to do that. Okay, so let's start studying question number 7. Skylark USA currently exports 500 calculators per month to UAE. Now, be very attentive in this question, because this is a whole new concept that you'll be doing. Okay, so understand the scenario. Currently, the export is going on in the same country where they want you to manufacture. Sir, what? Look at carefully. This is a company in the US, and they are basically exporting, okay, exporting to UAE. What? Calculators 500 per month, okay, means yearly will be 6,000. The variable cost is 40. The company was approached by the government of UAE, Dubai. खुद ही बोला, they said themselves that why don't you establish a manufacturing plant in UAE itself? But your amount is coming, your items are coming over there. Why can't you do that? It is very similar that Indians had a very good charm of using iPhones. Okay, iPhones. So then Indian government said to the Apple company that why don't you make a manufacturing facility in India, Baba? Our citizens will get at a lower price, at a cheaper price. Okay. As you know, there are iPhone manufacturers in China, but it assembles in the US. Okay. The parts are made from China. It's written on the back. Okay. I don't know now it is written or not, but when I was using it, I saw it. It was written made in China, assembled in US. Okay. So they said, why don't you make a manufacturing facility in India? They said, okay, fine, we can do that. That's not a problem. Okay. So similar way, it says, why don't you make a manufacturing facility in our country? We will give you the subsidiary. Okay. After careful analysis, the company decided to make an equity investment of 1 million, half of which would be represent the working capital and half of which will be the fixed asset. So not a big problem. The company would sell the plant to a local entrepreneur for a sum of 1 million at the end of 5 years. Okay. So this is a salvage value. Okay. And the Central Bank of UAE would repay the company 5 lakh for the working capital. They will release the working capital. Okay. Simple. 1 million is required means 10 lakh. Okay. So 5 lakh will be for the plant and 5 lakh will be for the working capital, and they will get a repayment after the 5 years time period. In return for an increase in tariffs against other companies, Skylark will sell the calculator from $60 to $50 per unit. Okay. In addition, the company undertakes to buy certain raw materials from the local suppliers and also employ some local managers. Local means the people who are located in Dubai itself. The total cost of the local managers and materials will be rupees 15 per calculator. Okay. So you can see the cost has tremendously come down from 40 to 50. Other materials purchased would be from the parent company, that is 10, and the company would receive a direct contribution to the overhead variable cost of rupees 5 per unit sold. Okay. So they will be paying them 5 rupees as the overall overhead variable cost. Maybe the cost they were absorbing earlier in this, now they will be charging from there. And you will have the total cost of the material as 15 and $10 as the other material. Under this arrangement, the company expect to sell 1,000 calculators per month. Okay, so earlier they were selling 500. Now they will have much more revenue, almost double revenue. Okay, the fixed asset are to be depreciated on a 5 years life period. That was understandable because this is mentioned above only. The company will have to pay a tax of 50% of the profits earned in the UAE and also 50% on the United States. The current exchange rate is 10 UAE dinar per dollar. So $1 is equals to 10 UAE dinar. Okay. And it is expected to stay the same for the next 5 years. There is no restriction on the cash flow repatriation. What does repatriation basically means, beta? Repatriation basically means that you can send your money here and there. That will not be restriction. So you are required to determine the adjusted present value of the project. A lot many students got terrified by looking at this word. What does adjusted mean? And those who were not terrified, they did it normally and they lost a lot of marks because they did not follow the formula that we just discussed few minutes back. Okay. Now the onus is on you that you are discussing that formula with the examiners properly so that you can get the marks. Okay, beta, this is clear? Acha. Now there is one catch over here. Sir, what is the catch? Okay. As I told you, for the adjusted present value, you need 4 things. Sir, what all 4 things can you repeat? Yes. Number 1 is your operating cash flows, present value. Okay. Yes, sir. You need interest cost for the tax shield as a present value. Yes, sir. You need the interest subsidiary as its present value. Yes, sir. And number 4, you need a cash outflow. Yes or not? I hope you have written it in your notebook, the concept that I just taught. Okay. So there, all these 4 things are required to be totaled up. Okay. And this was reduced so that you can get your adjusted NPV. It could be either positive, it could be either negative. Clear or not? Yes, sir. Now look at one thing. What, sir? This thing and this thing is not given in the question. Look at again. Has he talked about anything about the interest cost or anything about the interest subsidiary? No. So why should we worry for that? This one and this one. Both of them are not there in this question. Sir, will that be the case every time? No, 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 no. It will not be the case every time. We will be discussing another question where the examiner has given all these components. Okay, so this thing and this thing is not given. This thing is given and this thing is given. Clear, beta? Can we solve this? How to do the calculation? Let's understand. Okay. Let me make you understand the whole framework. Please keep the study material, this assignment intact with you so that we can study this. Okay. Now, this is basically a company which is in US. They are exporting 500 calculators. Okay. Now this in UAE. Now they're saying, why don't you set up a plant in UAE? Okay. And from here, the revenue will be 1,000 calculators. Okay. 1,000 calculators will be. So why don't you make that? This is what they're asking. Okay. So we will see what is the cash flow from manufacturing of this. Okay. And what is the cash flow from exports? First calculation is cash flow from exports to UAE, and what is the cash flow from this is over here. ये अच्छा ये currently export किया जा रहा है ठीक है सही ठीक है so 500 are exported from this 1,000 will be from the manufacturing हाँ ठीक okay okay this 1,000 will be from manufacturing okay and cash flow from exports okay we have to see both of them and then we have to decide accordingly. Clear beta? Not a problem. So can we do that? Okay, not an issue. Chalo, let's try and solve this. Number 1, A, calculation of cash flows from exports of calculators. So first one we'll calculate for the exports, then we'll calculate for the manufacturing. Clear? So what will be the revenue? Can you identify? Okay. Currently, they exports 500 calculators at the rate of 60 per piece. For that, the variable cost comes to be 40. Okay. So your contribution becomes 20 into 500 calculators. Clear? So it comes out to be how much? Into 12 because this is per month. Okay. So 6,000 into 20. So that becomes 1,20,000. Okay. And reduced by taxes, which is 50%. Clear, everyone? So you're not claiming any depreciation on that. Okay. Clear? Chalo, let me take you there. 500 into 60 less variable cost 500 into 30. Okay, so net you get 30,000, 15,000, and you will get, oh, sorry, it is 40. Huh? 20,000. Okay, so 10,000 is what you are getting your contribution. Okay, no fixed cost. Again, exports are there, as Harshad was asking. Okay, per month. Okay, so contribution per year, per annum, 1,20,000. Okay, and reduced by taxes because there is no interest. Okay, 60,000 straightforwardly is our cash flow after taxes. Simple calculation, simple, no technicality is there. 500 units per month, 60 rupees is the selling price, export price, and 40 rupees is what the manufacturing cost, variable cost. And you are getting a yearly cash flow after taxes. Currently, you are getting 60,000. I hope you'll remember this figure. Okay, na? Okay. Now, the second calculation, okay, the second calculation will be calculation of cash flow, okay, from manufacturing in UAE, okay, for manufacturing in UAE. So now, should we take you back again to the assignment and see now what do you expect to achieve from here? Number one, beta, the quantity will become 1,000 per month again, so 12,000 in a year. The selling price will be 50, variable cost is 15, 10 to the parent company, and 5 as a some overhead variable cost. Okay, other materials. So can we calculate that? 15, 10, and 5, 25, 30, 30. Okay, 20 will be that. Okay. So I'm doing again for this also 1 month on a monthly basis. This is local cost. Okay. This is other material is 10 and overhead cost is 5. 15. अच्छा पहले वाला 15 था सर. Okay, 15, 10, हाँ, 15, 10, and 5. Okay, so this is 25 and 30. So that comes out to be 30,000. Okay, so 20,000 is what your contribution per month. Okay, contribution per annum will be 2,40,000. Yes or no? Clear? अभी तक समझ में आ रहा है? You're able to understand till now? Okay. So we have just calculated what will be the contribution per annum in manufacturing in UAE, and what is the contribution per annum which is from the existingly exports to the UAE. Okay, so both are clear. Here we have to take one more thing. Okay, you have to take the impact of taxes. Okay, less taxes, which is at the rate of 50%. Clear? So 1,20,000. Okay, and one more thing will be there. 120 will be there. Okay, that is your profit after tax. You will add back the depreciation as well. Okay, the tax saving on the depreciation. So depreciation, you know, you have a value of total was 1 million. Okay, 10 lakhs. So plant and machinery was amounting to 5 lakh divided by the years was 10, and you get 50,000 as your. Oh, sorry, 1 lakh. Five years was there. 5 years was. You want to see it again? I think I've confused you. Sorry for that. Yeah, so you can see from here again. Okay, so the value is for total is 1 million. Okay, so your fixed asset is for 5 lakh and depreciation is for 5 years. So 1 lakh will be the depreciation. Okay, I just showed you just in case I confused you over there. Okay, so now we add back the depreciation. Okay, so 1 lakh into 50% depreciation benefit. Okay, tax saving. So that will be 50,000. Okay, so that will be added 1,70,000. Clear, beta? 170 is what you are getting after this thing, and earlier you were getting 60,000 from. Okay, clear? Now step number 3. Okay, cash outflow, we all know it's 1 million means 10 lakh. Okay, we all know that. So now the thing is that we have to calculate the NPV first, and then we can see how we can do that adjusted NPV. Okay, chalo. I hope everybody has saved from here. No further doubts. So now comes is the computation of the NPV, adjusted NPV, the main thing. Okay, so number 1, first we'll write the years here, 1 to 5, 5th year. Okay, 2 things are happening in the 5th year, so I'm writing as 2. I'll tell you what 2 things are happening. Okay, this is 1 to 5 years. This is your cash flow after taxes. Okay, 1 to 5 years. So you just have calculated that. Okay, the figure of 170, if you remember. Okay, that 120 plus 50,000, 170. Okay, clear? 170 is clear. On the 5th year, you are also selling your machinery. Okay, you're also selling your machinery. You will get the benefit of that sale. Okay, now how much are we selling for? Just see carefully. It's given on the first line itself. The company would sell the plant to a local entrepreneur for a sum of 1 million. Okay, after 5 years. 1 million means 10 lakh. So you will be selling that at 10 lakhs, okay, or 1 million, and you will have to pay the taxes on that. Okay, so you will write the sale proceeds after taxes over there. Okay, and you will get the repayment also of the working capital in the 50. So both of the impact of this we are taking. Getting my point? Easy है ना? डरना नहीं है. Okay. Okay. So 5th year, this is your 10 lakhs into 50%. Okay. I'll write it. Sale of plant. Okay. And then you can write this thing, which is your 5 lakh. Release of working capital. Clear? Nothing technical we have done. You must be thinking, sir, you scared us with the concept of adjusted NPV. Nothing. Till now, no concept of adjusted NPV is there. But it will come for sure soon, today only. Okay, just wait and watch. Clear? Yes, sir. So this is clear? Yes, sir. So you can you do the present value? Don't require, because I think the examiner is these days is giving you the present value factor. Okay, so it might not have been given here. Okay, but let's say they are giving you. So for 10 year, 10% for 5 years. Okay, 1 divided by 1.1. Okay, so for the 5th year is 0.621. Let me write that first. And then I'll do the grand total. For the 5th year, it is 0.621, 0.621. Okay, and the grand total comes at 3.79. Or say 1. Clear, beta? You will get the discounted cash flow after taxes. Six double four 434. And for this one, it will be 10 lakh. First we'll do 50%, 5 lakh, and then 0.621. So 310500. Please, you also do, even if you're doing it after the class. I mean, you're watching this video on recorded basis, then also you should be knowing. Okay, beta? And this will also be the same, obviously, logically. Okay. Okay. So what will be the total? Can I write the total here? You can make it like this, or you can make the vertical. Not a problem. Examiner just needs the answer. Nothing much. 310500 into 2 plus 644 434. So 12654 34. Okay, Ji. And reduced by cash outflow. Sir, where have you taken that present value of the tax sheet? But a tax interest rate is given, not given to you. So that's nil. Okay, sir. And what about, sir, interest subsidiary? That is not given to you. Sir, will you cover it today? Absolutely. Okay. So 10 millions. 265434. Yes or no? Yes, sir. Sir, but tell me one thing. Sir, why did you calculate it that 60,000? Yes. Yeah, 265434. Clear? Clear. Yes. Now, sir, why did you ask us to calculate in point number 1 what will be the cash flow from the exports to UAE? But I am saying that just in case, this is basically your net present value if you calculate. Okay, so this is your net present value. Okay, from manufacturing. So if I say you reduce the present value of the loss that could happen due to rejection of the project. Okay, rejection of the project. Just see what I'm writing. The present value of the loss that could be there where the project is rejected. Okay, so currently you're earning 60,000 and you're expected to earn it for a period of 5 years. So today, if you don't do that, you will incur a loss today. Okay, because see, if you are refusing them that no, we will not open up the subsidiary, UAE government has said, so you might, the government might restrict your exports that you are doing. So you could lose that money. So the value today of that loss of 60, 60, 60, 60, 60, 5 years, 60,000 that you will be earning, how much your loss you can bear it today? 3.791. How much? 227,460. Okay. Okay. So still you are in profit. So this is your net gains. Net gains to the company. Clear, beta? Sir, is it required to show this step, beta? Absolutely. See, whenever the examiner is giving you any kind of information, obviously he is quite logical. He is not giving you unnecessary information for unnecessary purpose. Try and see where you can fit that. Okay, that's the most important. Okay, so as of now, there was this question where you have to calculate you wanted to calculate the adjusted NPV, but no other things was given it to you. Okay, if there is no doubt, before I go to the last question, I would like to discuss a very spectacular question which came in your November 20 exam. Okay, but for that you will have to wait for few seconds. Okay, just few seconds. Let me open up that. So there was a this is a very good question that came in the exam in your November 2020 exam, asking you to calculate the adjusted NPV and the variables which are of, say, what do you call that? Interest and all these things are given to you. Okay, just one second. Okay, so I want to just one thing. I'll just show you the question, beta. Okay, because I have not given it in the assignment, that one. So yeah. I hope now it will be visible to you. Yeah. I hope that's visible, beta. So again, a very spectacular question in November 2020 given by the examiner, and they were asking you to do that. Okay. So this question I have not given in your assignment because I wanted to do live in the class. And after that, we'll only be remaining with only one question. That is question number, I think the last one, which is 8. That we can cover up very easily. It's a very nicely prepared. Okay. Yeah. Harshad is asking a question. Company made investment of 5 lakh in fixed asset and 5 lakh in working capital, and in return, company gets 10 lakh against fixed asset for working capital against and 5 lakh for working capital from government. Then where is 5 lakh additional in our calculation? Okay, let me just think or see what he's asking. I'll have to open up that assignment again. Just one second. Which question? Question number 5, I guess. Right. Skylark wala question was there, right? Yeah. Okay, so I hope the assignment is visible, Harshad. Okay. See beta carefully, don't get confused. Company made a total investment of 10 lakhs, okay, out of which for fixed asset it was 5 lakh, okay, and working capital was 5 lakh, okay. This was sold, okay, this 5 lakh wala item was sold to a local entrepreneur for a sum of same, that is 10 lakhs. So even if we had taken the depreciation over here, for us the cost was nil because we have taken a depreciation of 5 lakh divided by 5. So 1 lakh depreciation you already claimed. So for us the value was nil. Okay, so for us the value was nil, but they say it was sold for 10 lakhs. Okay, so straight line basis में over a period of 5 years we are depreciating. For us the value becomes 0 at the end of the 5 years, but still we are able to sell this at 1 million, that is 10 lakhs. Okay. Now, is there any other doubt? Company made investment of 5 lakh in fixed asset. Yes, this have written, and 5 lakh in working capital. In return, company gets 10 lakh against a fixed asset. Yes, and 5 lakh. No. That 5 lakh that you're talking about, Harshad, that is the depreciation that we have claimed, and the benefit of that depreciation we have already taken. Okay, if you have seen the working, if I have that working, so yes, I have that working. Okay, so in this 170 that we had calculated, okay, we have taken the impact of that 1 lakh depreciation, okay, into 50%, and then we had come to this 170, and then further we have. Is it clear, beta? Harshad, just confirm me. I have to take you to the next examination question. Let me know if that is clear. Sure. I am rubbing all this now, huh? If you have any further doubts, do tell me. Okay, is it clear now? Sure. Let's solve this question. This is very important. This came in your exam in November 20. The management of a multinational company, TL Limited, is engaged in the construction of infrastructure project. A proposal to construct a toll road in Nepal is under consideration of the management. The following information is available. Okay. The initial equipment will be in purchase of the equipment costing 250 lakhs USD. The economic life of the equipment is 10 years. The depreciation on equipment will be charged on a straight line method. Okay, clear? Harshad बता दो clear हुआ कि नहीं? Otherwise, what I'll keep guessing कि समझ ही नहीं आया. Okay. So again, this is a very nicely prepared question, and luckily all the things has been given to us, all this NPV and all. Okay, na? So present value and also that will not be problem. So this is a company in India, and this is a company in Nepal. So company is supposed to make a toll road in Nepal. Okay, the investment that the company will be doing, okay, the cash outflow will be for 250 lakhs. Life will be for 10 years, and depreciation will be charged on the straight line method. So becomes 25. Easy. EBITDA to be collected from the toll road is projected to be USD 33 lakhs per annum. Okay, so this is not an Indian company. Sorry, this is a US company. Okay, W that is given to you in the US. Okay, so USA company wants to make it in Nepal. So EBITDA is already given, means sub variable cost वगैरह सब निकाल के everything is given. It says it will be costing around 33 lakhs per annum for a period of 20 years. So luckily the present value factor for 20th year and the cumulative is also given. The annuity factor is so good. To encourage the investment, Nepalese government is offering a 15-year loan. Now the interest part will come over here, and now you will use the adjusted net present value wala formula that I just spoke with. Okay. To encourage the investment, the Nepalese government is offering a 15% loan at the rate of 6% per annum. Okay. At the rate of 6% per annum. The interest to be paid annually. Okay. The required rate of return on all the projects is 12%. Clear? Now, the post-tax cost of debt is 5.6%. Okay, so means KD after tax is 5.6 divided by 30%. Oh, sorry, 70. 5.6. If that represents 70%, so full will be 8%. Cost of debt is 8%. Okay. Corporate tax rate is 30%, and all the cash flow will be in the USD. You are required to advise the management on the viability of the proposal by using the adjusted net present value method. The present value and everything is given. Okay. I know this question, I did not share it with you on the assignment. So don't worry, I will not be harsh on you. You can read the entire question again. I will wait for 2 minutes. Okay, beta? I'll talk to Harshad. My point is why we are taking depreciation as 511. When we get -5, that means we are profit, no need to charge depreciation. Beta, depreciation is a separate thing. Harshad, beta, you're a very intelligent student. So you will understand this thing. That depreciation is important because it does not matter that what is the price that you are getting after this. Depreciation is there. If I ask you that I'm selling you this calculator, okay? I'm selling you this calculator for 500, okay? And you can further sell it after, say, 1 year for, let's say, same 500. So it means you will not charge depreciation in your books. Depreciation has a non-cash flow impact. And that same 500 will be your revenue. मुझसे 500 में खरीदा, and after 1 year you will sell it again at 500. So it means you will not charge depreciation on that. It's something which is required, logically. So you will charge depreciation in your books, and you will show the entire gain as your profit. That see, even if after charging depreciation, I was able to sell it at a higher price. So depreciation is one other thing, okay, and selling at a higher price is something different. Okay, beta, clear hai? Chaliye. Any doubts still here, beta? Or we can move to the question. So now we can just remove all this and start making the calculations. Okay. So again, a very good question, and we will be discussing that and using all the thing which is there. Okay. So सबसे पहले, the first thing is to calculate the base NPV. Okay, that is the operational cash flows. Okay. So number 1, calculation of operating cash flows. Loan is different. Sairam, good to see you. Good morning. Okay, don't worry. Don't get confused. I mean, I have confused you. Don't worry. I'm not saying that you got confused. I confused you with that 8% rate. That is a separate one. That is required for the present value factor, bacha. That is required for the present value factor. That 6% is the amount of interest that will be paid. Abhi I have not started. Just wait for 2 minutes. You will get the understanding for sure. Okay. And from where did I get the hint that I have to use that? From here. See, 8% is given to you. Oops. See this. Okay, this 8% is given to you. Okay. So this is for the present value factor. And yes, the loan is definitely for this much, 6%. Where is that? 6% per annum कहाँ लिखा था? Yes, this one. You're absolutely right, Saira. No doubts in that. Okay. This is for the interest computation, and this is for the present value factor that I did the pre-tax, post-tax, pre-tax. Okay, don't worry. Okay, but good. You are very attentive. Very good. Very good. Calculation of the operation. ये मैं क्या लिख रहा था? Calculation of the net present value लिख देता हूँ on a simple note. We can also call it as a base NPV. Okay, the operational cash flows. Okay, so base NPV, because we will be adding the impact of the interest tax shield in this question. Okay, chalo. Now let's understand the impacts separately. Okay, here will be the heading. Let's do the particulars. Okay, the time or the period. Okay, the amount will be in dollars, lakhs. Okay, to remove confusions. Present value factor at the rate of 12% is given. Okay, and the present value. Okay, clear? So number one, EBITDA. This is already given to you. Okay, how much? 33 for a period of 20 years. Clear? 20 years के लिए you will get 33 as this thing. Present value we'll see, don't worry. Okay, what is the tax you will have to pay for 1 to 20 years? This is at the rate of, I think, 30%, if I'm not wrong. Thank you, Harshad. Thank you. Finally, it's a relieving moment when the student when the student gets satisfied with the answer. Okay. Okay. Depreciation we have already computed, huh? 25, you remember? 250 divided by 10. So I'll write it again. 1 to 10 years. Okay, that is 25. Okay, and the tax saving on depreciation, 1 to 10 years, that is iska 30%. I think 7.5, right? 7.5. Is it clear till here, beta? Okay. So EBITDA is given, tax is given, depreciation we have taken the impact, and the tax saving on that. Even if you want to skip this step in the exam, you can, not a problem. You can directly write the tax saving on the depreciation because you've already calculated the depreciation. Seriously, not required. Okay, but I just showed you for your understanding. Even if you want to, what do you call that? You want to, don't show it in the exam, you can just leave it. Okay, that's really not a problem. Okay, if it's confusing you, then I can erase this. Okay, this was just to show you. You can remove this. Yeah. Now we are coming back to the sheet so that we can see the values. Okay, chalo. So present value factor for 12%. Okay, for 10 years is 5.650. ठीक है. $5.650. Okay. For other two, $7.469. Okay, for this. Abhi 8% we will come later. Okay, so we have used this. We are using the 7.469. Clear, beta? So can you solve this? Ab to easy ho gaya. So 33 into 7.469. So this will be 246.47. Okay, and 9.9 into 7.469. So that will be 73.94. Okay. And this will be 7.5 into 5.65. 42.375. Okay, beta. So this comes out to be the cash flow. $214.91, my house number, and less cash outflow 250. Oh, negative. Oh, so the net cash flow, the NPV, the base NPV is coming out to be negative. How much? 35.09. How? Why should we be concerned? It's just a question. It's not our own NPV, right? So this is something which we have done it earlier. Nothing new concept. The EBITDA was already given to you. The tax rate was given to you. Depreciation contents were given to you. The very first question of today's class, what we did is the same. Okay. So till now, no new concept in the adjusted NPV. What about the further one? Let's discuss that. Can I rub this? Okay. Will you be able to remember this figure? 35.09. Okay. Chal. Now we'll say second point, calculation of present value of impact of financing. This a lot of students could not do it in the examination. Okay, na? We'll do it. Let's start doing it. How do you write? Same. You can write it as particulars. Okay. The time. Say the amount. This will also be beta in the US dollars, lakhs. Okay. Present value factor at the rate of 8%. अब ये 8 कहाँ से आया था? From where did we get? 5.6% was post-tax. Okay, so for discounting purposes, we divide by 0.70 because 5.6% represents 70%. So total was coming at 8%. Okay, don't worry, Saira, I'm coming to your point. You were absolutely correct. Now I'll be discussing that. Okay, so what is the loan amount that you have taken? Number one, the loan amount that you have taken for on the zero period is for the amount 150 lakhs. Okay, present value we will see. Abhi to iska on the day one hai, to 150 would be the loan amount. Okay, interest. Okay, for a period of 15 years. Okay, see carefully. To encourage offering a 15% term loan of USD 150 lakh at the interest of 6% per annum. Okay, so 150 ke upar you'll get 6%, that is interest is to be paid annually. Okay, so interest is equals to 9 lakh dollar. Okay, clear? Acha, what will be the tax saving beta? Tax saving on interest 9 ka 30%, that is 2.7. Okay, and then you'll make a repayment of 150 back, the one you bought it earlier. Clear? Can we incorporate these figures in that? Sir, are you making us ratify? No, I'm not ratifying this concept. This is very simple and straightforward. You can do it directly. Don't need to make a table. Don't make a table in the exam, Baba. Nobody's asking you to make such table. This table is made only and only for your understanding purposes. That's it. Nothing to be. You want to do it directly in the exam in a single line, you can do that. Examiner has no problem with that. What problem is that is for your wrong working. Okay, nothing else. Okay. So is this all clear? Okay. So the interest amount is there. The amount will be for interest is there, amount is 9 lakh. Okay, negative because it's an outflow. The present value factor, oh, that I missed. I'll see it right now. Okay, then tax saving on interest. This is what is required for a period of 152.7. Okay, and repayment in the 15th year, which will be of 150. Clear? And here you will get the present value impact on finance. Okay, let's go to the assignment, check the values quickly. Okay, beta. So for 15 years, annuity factor is given. Total is 8.559 and 0.315 for the 15th year, in which you will be making the repayment. This is how I'm just taken the screenshot from your answer, from the question of the exam. So I just want to tell you how the exams question are coming, and I would like to discuss them in the VCC Board of Studies classes. Okay, chalo, chale. Eight point 559, 8.559 and 0.315. First one, no calculation required, into 9. 77 point 23.10. Okay. $47.25 in negative. Okay. I think this will also be negative, right? Yeah. Loan to aaya, interest paid, tax saving received, and made a repayment. Okay, done. So plus 77.031 plus 23.1 plus 150. 297.381. No. Seems absurd. ऐसे कैसे हो गया? एक सेकंड. 150 minus 77.031 plus 23.1 minus 47.25. Yeah. 48.54. Clear बेटा? अब तक clear है? No doubts? Okay. So this is the present value impact. Okay, clear? Acha, now, as I told you the formula, you remember the formula? I told you 3 things: base NPV, tax shield, okay, means tax saving on the interest. That is there. Which one? What is that amount? This one is there. For the purpose of adjusted NPV. Now you will say, sir, that is fine. But then why did you ask us to do this entire calculation? Do we need that? I'll tell you why. See, your final answer is this only. In the exam, your final answer is this only. I'll tell you what. Come here. In the exam, your final answer is adjusted NPV is equals to base NPV plus the present value of tax shield on interest. Okay, so the base NPV is we had calculated earlier, right? 35.01 something. Yeah, 35.091. Okay, this was in negative, right? Plus present value of this, that is tax saving on the interest, that is 23.10. Still, you will get a negative NPV, 35.09 minus 23.1. Still your NPV will be negative of 11.99 lakhs. So project is rejected. Clear? Yes, sir. This is the final answer. Sir, we understand that. Sir, this we can do it in the exam in one line itself. You must be thinking, sir, we can do this in one line. What is the need to do this entire calculation? I'll tell you. But the suggested answer that you have received. So suggestion means the answers are given by the ICAI. Okay, sir. There, what they have done is they have said this as like this. The adjusted NPV is base NPV plus present value of the impact of the financing, the total amount. Okay. So, sir, which one is correct? This could be your next question. I know this could be your next question. So, present value of impact of financing. Okay. This one, that is 48.54. Now, by this you will have a positive NPV, 48.54 minus 35.09. So that will come out to be 13.45 as a positive NPV. So now the project is accepted. Okay? Sir, calculations we know better than you. Calculations aata hai. Now what the thing is, sir, which one is the correct one? Beta, the answer both of them is correct. Sir, why? Yeah. Because whenever the suggested answer comes, okay, they keep in mind what the students have done in the examination. Sir, what? Okay. You give the exams? Yes, sir. You get the result in 1 or 2 months? Yes, sir. After that, your suggested answer comes. So that for the next attempt, students can prepare that. Okay, sir. So the examiner has given you both the answer that if you take it like this, then also I will give you the credit of the marks. If you do it like only the tax saving of the interest, then also I will give you the credit. But if you ask me logically, the correct answer will be that we did earlier than this one, tax saving on the interest. Because in the study material, they themselves have said that you have to take 3 things while calculating the adjusted NPV. Number 1, the base NPV, present value of the base NPV. Number 2, the present value of this word they have used, tax shield. Okay, interest tax shield plus present value of the subsidiary, interest subsidy. Subsidy is not given this question, so again that becomes easier. It might be possible in your exam you get your interest subsidy. Okay, that will be a game changer. So if you ask me what is the correct approach to do it in the exam, this one will be there. But just in case you take this value, you will also get the credit of the marks. This is what the suggested answer has said. Clear, beta? I hope this doubt is there. Naveen has asked one question. So the discounting factor is different from the operating cash flows and yes, the 2 discounting factors you have taken. You're absolutely correct. In the base NPV we took 12%, and in this one we took 8%. This is what I asked you to write. You remember in the whiteboard I wrote it with a black pen, so that you can remember it. You are using different discount rate, and in case the interest subsidy comes, then also you will be using a different discount rate. You add them and you reduce with the cash out. Okay, so the discounting factor is different from operating cash flows and financial. That is why we are making adjustment to present instead of adjusting it with the cash flows. You are absolutely correct. Brilliant thoughts. You are interpreting what I wrote when I was teaching you the adjusted entry. This shows your attentiveness in the class, Naveen. Absolutely correct. Very good. So I think that ends up our question, and coincidentally, it's exactly 9 o'clock as well. So what we can do is we can take a break for 5-7 minutes, and then we can come back with the question number last, which is remaining, which is question number 8. Then we'll discuss some other important theories as far as the exam is concerned. Okay. So before we leave, I will share with you the last question, which is the assignment. Okay. Yeah. We have to cover up this question now. Again, a very important concept of the MIRR will be over here. I thought first I will discuss the two approaches, which is the home currency and foreign currency. And then I will discuss the adjusted NPV. Third is the concept of MIRR. Okay. So, beta, now we are on the last question for the class. And this also evaluates a new concept. And a lot of students have a problem in understanding that how this MIRR has been calculated in study material. Sometimes students have a problem. So I will try to take care of their this thing as well. Okay. Just one small request. I just forgot to mention there was some further things as well over here. Okay. Just tell you what was there. I hope in the break time you must have read this question. Okay. But just in case you couldn't, I will tell you one thing. Let's start study, and then I'll tell you in the last. I have to mention you something. Okay, I'll tell you that. Okay, so let's start solving this question. XY Limited, a company which is based in India, manufacture a very high quality modern furniture and sells to a small number of retailers in India and Nepal. Okay. A Nepal name is coming a lot of time today. Huh? It is facing a tough competition. Recent studies on the marketability product have been clearly indicating that customer is now more interested in variety and choice rather than exclusivity and the exceptional quality. Okay, these days it is happening, right? We don't want to see our furniture for 10 years, 20 years, 30 years. You want such kind of furniture which is maybe little cheaper. We can use it for a few years and then we can discard and get a new one as per the trend. So since the cost of quality wood in India is very high, the company is reviewing the proposal for the imports of goods in bulk from the Nepalese customer. Okay, from the Nepalese customer. Okay, the estimate Indian quality good, the proposal for import. Okay, import of goods. Okay, from the Nepal. Okay, the estimate of the net Indian, that is in INR, and the Nepalese currency, which is NC, just like we did African rands wala question. The amounts are in millions. Cash flows in the nominal terms. Oh, wow. Good or not? It is given already in the nominal terms because we have already explained you that how do you convert the real cash flows into the nominal cash flows by using the concept of NRI, non-reliable, non-resident Indian in your income tax. Okay, for this proposal. That was on a tighter side. Nothing personal, please. Okay, so this is the year. This is the Nepalese currencies cash flow and Indian currencies, which is there. The following information is relevant. XYZ Limited is evaluates all investment using the discount rate at 9%. Okay, now all Nepalese customers are invoiced in the Nepalese customers currency only. The NC cash flows are converted to Indian at a forward rate discounted at the Indian rate. Now, which is this concept? Home currency approach or the foreign currency approach? Let's see how many students can answer. Okay, I'll continue. The inflation rate in India is expected to be 9% and 8% respectively. The current exchange rate is 1 is equals to 1.6 NCs. Okay, assuming you are the finance manager of XYZ, calculate the NPV that we can do and the modified internal rate of return of the proposal. Okay, sir. Okay. Achha, one thing I just forgot to get it typed in the this thing, that you are given a present value which is for year 1, 2, and 3, and you are given 0.917. Okay, 0.842. Don't worry, I'll write again, and 0.772. And you are also given a future value as well. Sir, what is a future value? Beta, one is a present value, something which is supposed to be received or paid later. You calculate value today. And what will be the future value? If you put in 100 rupees over here, and what will be the value after 10 years? That is called as a future value. So concept is same. These values are given to you 1.18, okay, and something 1.090 and 1. Don't worry, I'll be using that. So if you see your study material, this is already given. I've taken it from your study material. This question is from our very respectable study material, and we'll be solving that. Okay, beta? Mr. Harshad, congrats. You are a brilliant student because you have given this thing. You have given the correct one. Okay. So shall we move, students, on this? Okay, thank you. So we'll be doing this. It's a very, very nicely prepared study material question. And let me open the board. Just 1 second. Yes. Okay. So you are absolutely correct, Mr. Harshad. And we will ask you for furthermore questions. How do you proceed? Okay. The very first important thing is step number 1, that you cannot proceed unless you calculate the exchange, forward exchange rates. The very first step that I told you when I started my class on Wednesday, the very important thing in a NPV is that you need to calculate first the exchange rate. Okay. Then your NPVs 2A and 2B, remember, and then you can do the computations. Okay. So you are supposed to calculate solution 8. Okay. End of year 1. Okay. Have you seen that? 1.60 into inflation factor. Sir, we always have a problem which one to put in the top, which one to put in the down. Don't worry, I'll explain you. Achha. Now you tell me this 1.6. Can you see this? Yes, sir. Yes or no? Yes, sir. What is this? Sir, this is NC. Okay. Currency is there. So the inflation of that country will come in the numerator. Okay. And the other country will come in the denominator. Clear or not? Yes? Yes, sir. So clear? 1.6 into 1.09 and 1.08. (1.09) by 1.08. So how much you are getting, beta? 0.6 into 1.09 divided by 1.08. $1.614. Okay. End of year 2. $1.629. Should I do it 630 because 296? Huh? Okay, guys, clear? So can you remember these figures? Because we will be incorporating those figures going forward. Okay. So 1 point, no, nothing. 614, 644. Okay. Okay. Now step number 2 is calculation of NPV. But it is as brilliant question at we had done it in that African rands wala. Both of the masterpiece was from nowhere else but from our study material, where all such masterpieces are given. So we have to use the very same procedure. There is nothing new in that. The conversion shall take place, the cash flows will be added, present value will be done, and cash outflow will be reduced. Nothing different will be there. The only concept that this study material question has done is the concept of the MIRR. Okay. And a lot of times a student comes to me and say that, sir, we think that we have to ratify this formula. No, but sir has always been telling you in the class whenever he makes a visit that in the entire SFM, you have just only 4 and 5 formulas. Okay, so there is no formula as far as this working is concerned. This is purely logical and purely the compound interest formula that will be used. Hold your breath, we'll do it. Okay, so calculation of the NPV. So let's do it vertically now. Okay, so for year 1, 2, and 3, what is the cash flow in the Nepalese currency? We'll write it. Okay, forward rate. Let me write this first so that before it vanishes from my calculator. 1.614, 1.630, and 1.644. Clear? And this will be your cash flow in rupees, and this is the cash flow in rupees which is given to you. Okay, this is total. Okay, beta, and this is present value at the rate of 9% and the present value. Okay, everything is prepared. Our skeleton is prepared. चलिए. Okay, कहाँ गया? Yeah. Okay. So this is the cash outflow, right? So nothing to be done over here. 2.6, 3.8, and 4.10, and so on. Okay. So two point six, 3.8, and 4.10. Same thing. Okay. So can we use the forward rates to calculate that? $1.6109. Sir, what have you done? Beta, I have divided. Sir, why have you divided? Please go to my Forex class number 1, the concept of base currency. Okay, the concept of base currency will be required to be used. Okay, this is per rupees. This is in NCs, so the base currency is not same, so we divide. If that was same, that we always multiply. Okay, clear? So 3.8. That is why that is why I always say, and sir has always been compelling you to be very, very clear in your forex, right? Otherwise, that's the problem. So everybody has given the correct answer. Harshad, Naveen, Vidula. Yeah, very, very good. So brilliant students were there in my class. I was never aware. 2.33 and 4.1 divided by 1.644. Okay, clear? Now this is given. So let's check that as well. Oh, not this one. This is the another question. Sorry. Assignment. Yeah, this one. Sorry. So this is also given better. So 2.869, 4.2, and 4.6. We have computed. What we have done? We have not done anything. If you have attended my first class of this IFM, then it's easy. We have converted this cash flows into the cash flows in INR, because this is a home currency approach which everybody has given the correct answer. So we are converting the cash flows from Nepal. We are bringing that money in India, and we are converting. This is a home currency approach. We are in India, so we are following what is as per the INR. Brilliant, beta. Very nice. Okay. So 2.869, 4.2, and 4.6. Let's move that. Okay. 2.869, 4.2, and 4.6. Can we add them? Nothing difficult in adding. That's a simple thing one could have. So plus 4.6. Okay. So the total will comes out to be 7.093. Okay. So 2.331 plus 4.2, 6.531, 1.6109 plus 2.869, 4.479, 48. Let's do it like that. Okay, clear? Present value factor, not a problem. 1 divided by 1.09. Okay. 1 divided by 1.09. 842. 5.497. So let's take it that way. Almost coming same, huh? Okay, anyhow. Okay, that's okay. So can we do a total for this? Okay. 5.497 plus 4.11. Initial investments. Okay, the cash outflow. Is it simple? Sir, can you please give me compilation of all assignment questions? Definitely, beta. Why not? Why not? We'll provide you. Don't worry. Okay. Acha, initial investment kitna tha? That was in, I think, Nepalese currency. We'll have to convert that, right? So, Harshad beta, batao kitna hai? What is the outflow beta? 25. Okay, chalo, that's great. But we are doing it for home currency, so this 25 will be converted into with 1.96. Okay, so 225 divided by 1.60. Why divided? Forex class number 1. 15.625. Clear, everyone? Oh, negative 625. Feel sad, na? When the figure comes negative. We do a lot of efforts and then still we can't say that the project is viable. I personally feel, I don't know about you, maybe you get a great feeling. Yes, we did that. NPV, we saved our company's money before we entered into that 0.541. Okay, so that is your NPV. Clear till here? No new concept. Again, the masterpiece that we did, which masterpiece? The African rand wala question, which was from the study material, the same thing we have applied over here as well, and we have able to get through with the calculation of the NPV. No doubt still here. Okay, so now let's do the calculation of MIRR. Okay, no doubt still here. Chalo. Let me rub. We have for a little limited time, so I'm going a little faster. Battery is running out. Just 1 second. Let me just put the charger. Okay. Yeah. So calculation of MIRR. Okay. Calculation of MIRR, modified internal rate of return. Okay. So first of all, I'll tell you the logic basically, what this logic means. Okay. So beta, what happens is it talks about the concept of reinvestment. Reinvestment means, see, you must have studied bond valuation. Okay. I think sir had taught you very brilliantly. You must have understood. When we talk about the calculation of the yields, okay, the yield that we calculate, it is based on the assumption that whatever cash flow that you will get from the bonds will be reinvested and held till maturity. This is what sir would have taught you. I repeat that in bond valuation, it is assumed that all the cash flows that you receive in terms of interest, that is reinvested and you hold the bond till maturity. That is how you get the yield from the bond. Okay, yield to maturity, YTM. Okay, this must have been taught. So here also, what we are assuming is that whatever the inflows that we are getting, okay, at zero, you are investing how much? 15.625. यही था ना value? हाँ, 15.625. And in the year 1, you are getting something about some value. Then year 2 that you are getting, and year 3, 2 and 3. So you are reinvesting for 3 years. You are reinvesting it 2 till 3 years, and 3 years is already there. They don't understand? Come back again. I am saying, okay, for 2 minutes, forget this, that it's an NPV question. Okay, forget this. See, I have not taught you bonds, but I'm sure I will not able to explain in that good manner as sir would have told you. See, what is basically a bond? In year 1, you get interest. Okay. Year 2, you get interest. Year 3, you get interest. So the way is either you can collect that, okay, and credit to your account. Just like in mutual fund, you would have studied that there is a dividend model and there's a growth model. Dividend means you get the dividend whenever the scheme approves the dividend, and growth means the dividend that you receive is reinvested. You must have done a lot of questions where the dividends are reinvested, right? And very important questions you must have done. So this interest is getting reinvested. Okay. So similarly, this says that the cash flow that you are generating, you are not taking it out, you are reinvesting that. The one you generated in the first year, you are reinvesting till 3 years. The one that you are generating in year 2, you are keeping it in 3 years, and the third year wala you're already there. Okay. And then you see what is the R you are getting. So what this is R means? Beta, R means again compounding. What does in class 8th or 7th you would have studied that A is equals to P principal 1 plus R. Studied or not? This is what the same thing is. But here the T is 3, so you will write 3 here. And one more lot of things a student faces problems, sir. We take this kind of a calculator in exam. How to calculate the cube root here? Sir, I don't know how to calculate. This I will tell you in today's class. That is for sure. Okay? Okay. For 4 times, under root you can do it. You have under root option. And 4 times, twice under root. How to do it? 3, I will tell you today. Because a lot of students might not know. If you know, that's very good. That's very, very good. Okay. So this is how the concept is. So I hope you're clear with the concept. We can solve this. Okay. So I hope this is not a new formula for you. What is given in our study material, again, I'm not saying that is incorrect, but that is something it is given like this. I'll tell you. It says MIRR is equals to terminal cash flow by cash outflow, the initial outlay. Okay. And N is over here. So again, that is also not an incorrect one. This is absolutely correct. But sometimes students try to think that study material is asking us to rectify. No, study material will never do anything wrong. They're just telling you a shortcut for that. But again, there is no formulas as such. Apply a normal compounding formula and you will get it. All done? Chalo. Let's start with the question now without wasting any more time. No more discussions. Oh, wow. Students have calculated. Yes, sir, because we are prevented from incurring losses. Very good, Vidula. Very good. Very good, Sairam. Thank you so much. Very nice, Harshit. I think he has calculated the answer. So now, for the purpose of calculation of MIRR, what we need to do is we have to use the future value which is given in the answer, the question paper, which I could not share it with you. Okay, so that what is the present value did you get? The earlier one. This must be year first. Reinvestment, you can say, or you can say the future value. Okay, whatever, and the amount. So year 1, 2, and 3, the present value that you calculated was 4.107. Okay, 5.496 and 5.476, I guess. Same 496 496. Okay, this better reinvestment factor will be provided you in the exam. Okay, so I forgot to mention the question. So it is given to you as 1.188, 1.090, and 1. Sir, why this is 1? Because third year may you are getting what is there in the third year, so you are not getting any additional amount. Okay, what does future value means? That if I get something in year 1, I am reinvesting that till 3 years. So reinvesting that till 3 years means that I am getting 1.188 future value. Okay, like a compounding interest. Okay, so you can calculate that easily. 4.107 into 1.188. So you'll get 4. Is it correct? at the rate of 9%. So I am getting this as the first one, 4 point. Okay. Any mistake I've done? Is it so? Anything? So the figure is incorrect. Exactly. अच्छा, I have taken that. अच्छा, ये वाला value I've taken. अच्छा, ठीक है, ठीक है. I have to take the non-present value, है ना? This is the present value that I have taken. Okay. Sorry, I have to take the cash flows, right? Cash flows. Sorry. By mistake, I took the present value. It has to be the cash flows, right? So 4.479. Okay. The non-cash flow value. Students, is it fine? The total value 6.531 and 7.092. Okay, non-cash flow, non-present value. The total cash flows from Nepalese currency as well as the Indian currency. Clear? Now I can manipulate these values and get the correct answer. So, because present value that is required for the NPV purpose, now we are doing that this cash flow is reinvested for 3 years, 2 years, and respectively. So 4.479, okay, into 1.188. So it is 5.321. Okay, 6.531 into 1.09, 7.118 and 7.092. अच्छा, ये तो 1 ही हो गया, sorry, 7.092. So let me do the memory recall. This will give us 19.53 value. हाँ, second year figure is Saira, कौन सा बेटा? Second year figure is 5. The total cash flow beta ठीक लिया. Now it is fine. वो by mistake I have taken that present value. We have to take the cash flows. Okay. I was just getting little into anxiety because the time was running out. I thought, let me complete this question and I want to discuss the FCCB and the ADR wala question as well. That was why I was there. Okay. Chalo. This is clear, this is clear, this is clear. Can you do the total? Okay. So I hope you've understood the concept that what basically this MIRR basically means. Okay. So this is what it is 0. That is, we are investing 5.625. Okay. In the year 1, we are getting 4.479. This is reinvested. We are getting 6.531. Okay. And when we are reinvesting that, okay, yellow. When we are reinvesting that, okay, at this year, we are getting 5.321. When we are reinvesting that amount, we are getting 7.118. And in the year 2, we are getting the year 3, we are getting the 7.092. So that becomes same 7.092 and we get 19.53. This is all clear? Yes, sir. Can we use this figure? Yes, sir. देखो फिर. So 15.625, that is the principal amount, 1 plus r to the power of 3. This is equals to 19.533. So 1 plus r to the power of 3 becomes 19.533 by 15.625. Okay, and 1 plus r is equals to cube root of 19.533 divided by 15.625. So this is 1.250. Okay, so R will come out to be how much? I am putting the steps over here. For the calculator. Okay, in case you are taking this one, scientific is not allowed. Okay, so you have to do that. Please do under root 12 times. Okay, 12 times. Okay, then minus 1. Okay, divide by 3 plus 1. Okay, and multiply 12 times. Okay, this is coming out to be, and then minus 1 to करना ही है, R coming out 7.7%. Is it clear, beta? Try it at home. Okay, please do the under root 12 times, minus 1 divided by 3, and then multiply it again 12 times. Clear? And you will get the answer. Okay, so this is the percentage that you will get. Sorry, we are just running short of time, but you can just check it. Make the under root 12 times, then minus 1, divide by 3, and then multiply it by 12 times. You will get this answer 7.7. Means you will get 0.077, make it 7.7%. Okay, beta? So this is your MIRR. Okay. How the study material has done it, again, that is also absolutely correct. Who can challenge the Bible? But I'm just telling you that they have given you this formula, which a lot of students perceive to be a formula. But again, they have done it very logically. They are more logical than us. So they have done it like this. So this is MIRR is equals to the N here, terminal cash flow divided by initial outlay. So that will be, if I see this one, it will be 19.53, okay, divided by 15.625 to the cube root of 3, that is again 7.7%. But this is not a formula, beta. Formula is this only, P1 plus R to the power N is equals to A. They have just simplified this, study material has just simplified it. Don't think that study material wants to tell you that it's a formula. It's not a form. Okay, beta, clear? Okay. So if there is no doubt, let me now take about 15 minutes to complete a very small topic, which is this one. Okay, oh, not this one. Just 1 second, huh? Just 1 second. Where is our assignment? Yeah, I got the assignment. Sorry, the PPT that is must be available with you. Yes. So beta, we have luckily completed this entire topic well on time. Okay, international capital budgeting. Now the sources of finance. Okay, so two sources of finance are there. I mean, a lot of sources of finance are there. The majorly which is important is FCCB and the concept of ADR and ADR and GDR. Okay, I've given the entire this theory over here, again prepared from our study material, so you can refer that. Before we go to the FCCB, first I would like to go to the concept of what do you call as this ADR GDR, so that we can at least solve question number 2 for the time. Okay, yeah, this is the one. So American depository receipt, a very, very simple concept. I will explain you with one example, one example. Okay. And then you will understand. ADR, GDR is not a very difficult thing. It's a very, very simple thing. I will tell you. See, I will give you one company's example. Again, since although I'm not a shareholder for that, I'm giving you because this is a company which is required for our, understanding purposes. Okay. Have you heard about this company called Reliance Industries? Sir, obviously. who have not. Okay. Simply, see, very, very simple. Company have their equity shares. Obviously, sir, कहाँ दिखते हैं? We see it in the equity side. Okay. Basically, it means that these equity shares, who are the owners? Sir, promoters, Mr. Mukesh Ambani, Tina Ambani, and their children. Okay, this is the one. So basically, what you are doing is you are placing this equity shares with a custodian bank. Okay, and you are issuing depository receipts which are denominated in the US dollars. Sir, कुछ भी समझ नहीं आया. ठीक, I know that. Okay, see, Reliance want some money. Okay, Indian money, they can, sir, what's a big thing for them? They can just simply go to the bank, ICICI, HDFC, and take the money. No. He is finding the cost to be higher. He is finding the cost to be little higher. Okay, so what he is doing is he is trying to draw the money outside India. Okay. Do we trust Mr. Mukesh Ambani here? Obviously, sir, he has given us Jio, he has given us Reliance Retail, lot of things. Okay. But might be possible that if he is issuing a depository receipt outside India, okay, sir, then in that case, they might not trust them. Okay. So what is the criteria? When you go to the bank for a secured loan, what do you give? What do you give? Sir, any collateral, we give gold loan, we give our house, all those things. What does Mukesh Ambani can give it as a security to the foreign stock exchange? Can you imagine? Can he give his car? Can he give his watch? Can he give his house? No, it doesn't value to him. So he keeps his own equity shares with a bank outside India as a security. Getting the point? Okay. So he deposits his equity shares with a bank which is outside India. That is called as a custodian bank. You are getting my point? So this is Mr. Mukesh Ambani. Okay, MK. Mukesh Dhirubhai Ambani. MD. He wants to raise money from the USA. He will go to a custodian bank. Okay. And he will deposit his Reliance Industries shares with him. Sir, how much percentage? The amount of money that he wants. Say 1% or 0.5%. Okay? And once he deposits that money, he will get a receipt called as ADR, American Depository Receipt. Okay? So it is just like a person who is in US, okay, let's say John, he can buy this ADR. So indirectly, he is buying Reliance Industries from India. You're getting the point? His own shares, Reliance Industries shares, is listed in India. He pledges some, he deposits some shares to a custodian in USA, say Citibank. Now, custodian has his shares. If you do any manipulation, they can sell off their shares in the open market or anywhere. Okay? But that doesn't happen. Okay. So now somebody wants to become a shareholder of Reliance. So what he can do? He can't invest in India. Let's take an example. So he can buy the ADRs of a company. Okay. And he is entitled to that same benefits of an equity shareholder that any person in India would get. Just like Mukesh Ambani. He will get the voting rights, he will get the dividends, everything he will get. Okay. That's the same. So it is a unique feature. What is the benefit to Mr. Mukesh Dhirubhai Ambani? That firstly, he is getting the money at a very lower cost. Much cheaper cost. And secondly, the most important thing is that this certificate is denominated in the US dollar. So that currency fluctuation is not a problem for him. No problem of the currency fluctuation that he has to get worried about. Okay, clear? So this is how the thing is done as far as the American deposit receipts are concerned. Okay, and that represent a non-US based company. Okay, so should we read this and you will understand. A deposit is basically negotiable certificate instrument, means which can be transferred here and there like an equity share. They are denominated in the US dollars because they are ADRs. That represents a non-US company, means India, example Reliance Industries Limited. Okay, publicly traded in the local currency INR equity share security. Okay, since they are issued outside US, but instead of for trading in the US, they are called as the ADRs. What is the difference between ADR GDR? We'll do that. Don't worry. Okay, so ADR is generally created by depositing the shares of the Indian company, means Reliance Industries. Kiske saath? With whom? To a custodian bank. In the arrangement, the custodian bank, a depository is in the US issues the ADR, a depository. Okay, a depository. Like in India, there is a depository called as NSDL, NDSL, NSDL, whatever. Okay, so they will issue the ADR, and the person who buys that ADR will enjoy the same benefits over here. Clear, sir. Achha, sir, tell me one thing. Sir, what is the price of these ADRs? Beta, price of the ADRs exactly replicate the price in India. Sir, what does that mean? See, I don't know what's the Reliance price right now. I really don't know. Let's take an example that the Reliance price is, let's take number 25, just for easier calculation. Okay. And one ADR represents, let's say, 5 shares. I'm making the for question number 2. Okay, you are getting the point. I'm making the ground for question number 2. So one ADR represents 5 shares. So you get one ADR, it has 5 shares. Okay, 5 shares. So the value will be in INR. How much? 500. One ADR is equals to 500 INR. Yes or no? Yes, sir. And मान लीजिए, take example that $1 is equals to 50. So one ADR value will be how much? $10. Yes or no? Dobara. Let's take one share of Reliance Industries is how much? INR 2500. Okay, clear? One ADR represents 5 shares of Reliance Industries, and the spot rate is, मान लीजिए, it is 50 rupees per INR. So how much will ADR cost? One ADR will cost how much? $10. It will exactly replicate the current market price of this. Sir, what if this is not equal? But if that will not be equal, then then golden thing will come. That is the arbitrage. Somebody will buy from the lower and will sell at the higher market. The possibility of arbitrage will come. It always come in the market, but only for milliseconds or seconds. Okay, somebody can sell at the low price and somebody can sell at a higher price and buy at a lower. So that is why, since there is no arbitrage opportunity, these both price always converge. If Reliance Industries one day will fall, the ADR will also fall by almost same manner. But this is just for your training purposes. Sir has been telling you no trading. Clear? This is done. Now comes the concept of GDR. Let's complete that so that we can do the question on that. So nothing much difference, beta. Again, it's an instrument in the form of depository receipt, same as it was ADR, created by the overseas depository bank outside India. Okay. Now it is not important that this is US. It could be London. Okay. In reality, the Reliance Industries is having a GDR in Luxembourg. You know where the Luxembourg is? I think in London or Europe maybe. Okay, so they are denominated in US dollars and issued by a non-resident against the issue of the ordinary shares or the FCCB of the issuing company. Okay, it is traded in the stock exchange in Europe or USA or both. A GDR usually represents one or more shares or the convertible bonds of the issuing company. Okay, beta, clear? So the difference between ADR is that they are, although denominated in US dollar, this is also denominated in US dollars. This is also denominated in the US dollars, but GDR can be in Europe, in USA, or both. But ADRs are only and only in America. The difference is of the exchange. Sir, what if company faces losses after receipt of ADR? So what's the big deal? Just like the way, see, it is Sairam beta, it is replicating the price of their Indian equity share. Okay, so let's take an example. Losses is means, I mean, it is issued not by any company. I mean, ऐसा नहीं है कि you and me wants and we can issue an ADR, or Ashish sir wants to issue a GDR. That is not possible. Only the company with a very huge net worth can do that. So very few ADR, GDRs are there. Reliance is there, Infosys is there, Wipro is there, ICICI Bank is there. So handful of 5 to 10 companies are there. Not companies like Syntex Industries, which are loss making, or Aditya Birla Fashion, which is a loss making. No, not all these companies. Very big, high net worth companies. And if they are having a low performance based on the below the expectation, if they fall 2% in the Indian market, similarly they will fall 2% in the ADR as well. I mean, it just replicates, just like derivative replicates their underlying, they also replicate their underlying shares. That's the difference. Okay, beta. So, what about the last question? So we can understand that and we can complete today's class. We'll just take, I think, 5 minutes extra, okay, and then we can complete. It's a very good question, again from the study material, and this was also given in our very recent RTP also, okay. But again, I'm not saying RTP is the examination replication. It's just that you should be prepared if something comes. Odisha Limited has proposed to expand its operation, which requires a fund of 15 million, which are net of issue expenses. Okay, so they need 15 millions, which includes expenditure. So it means they will have to issue a higher amount. They need exactly 15 millions, and it involves 2% of the expenses. So they have to issue a higher amount. I mean, ask for a higher amount so that exactly they get after expenses 15 million rupees, $15 million. It proposed to raise the funds through the GDR. It considers the following factors in pricing the issue, which is the expected domestic market price of the share is rupees 300. Just like I told you, Reliance Industry is 2,500. So they are saying the domestic price of the Indian company is 300. 3 shares underlay each GDR means one GDR will have 3 shares. Just like I gave you the example that one GDR will have 5 Reliance Industry shares. Okay, but underlying shares are discounted at 10% to the market price, means for 300 they are getting 10% discount, yani ki little more cheaper. Okay, for 270 rupees. The expected exchange rate is 60. I gave you 50 as an example. You are required to compute the number of GDRs to be issued and the cost to the company if 20% dividend is expected to be paid with a growth rate of 20%. This has become now the examiner's favorite. You know, the concept of this E minus G wala concept. They are not only giving you in security valuation, they are giving you in IFM also, and recently they are giving you in your merger acquisition chapter as well. So please be very, very thorough with this. Okay, shall we start? I hope you have noted down the figures. We can do it in 5 minutes. Not a very big thing. Okay, clear? First of all, we need to know what is the cost of equity. Okay, but first of all, we'll tell what is the number of GDRs that is required. Okay, now last question. We'll take 5 minutes and then we'll wind up. Okay, solution number 2. First of all, number of GDRs be issued. Okay, so a required amount is 15 millions. Okay, so 2% is the issue expense. Okay, so how much they would be raising? amount to be raised is $15 million. That is what they require, 0.98. Simple, 2% is the issue expense. So represent something higher amount. The additional amount will be going to people like you, chartered accountants. Okay, so they will have to issue 15.306 millions, so that this 0.306 goes to the investment bank. Okay. What will be the price of GDR? Okay. The issue price is, although 300, subject to 10% discount. Okay. So therefore it will be 270. 1 GDR will be equals to 3 equity shares. Okay. So price will be 270 into 3, that is INR 810. I told you that 2500 divided by 50, all those working same. I was telling you I'm preparing the ground for question number 2. Okay, this is clear. So this is in rupees, beta. We have to convert this into dollars. Okay, price in US dollars, 60 rupees is the price which is given. Okay, so 810 divided by 60. Okay, so it will be 13.5 dollar. Okay, and total number of GDRs will be this much. 15.306 divided by 13.50. This is beta amount. This is amount we are getting the number of GDR, means the quantity. Okay, how much quantity is to be issued. So you will be issuing 1.1338 millions GDRs. This is quantity. Okay, quantity. This is the total amount. This is the price per GDR. Okay, per GDR. So this is the quantity, how much we have to issue. So that completes our first part. Okay, the number of GDRs to be issued. Okay, and the second one is, the second one is this says you are required to compute the number of GDR that we have done and the cost of GDR to the company if 20% dividend is expected to be paid with a growth rate of 20%. So easy. You will say the cost of GDR will be, cost of GDR will be using that formula which we know, D1 upon PO plus G. Clear? So how much dividend we will be getting, beta? You have 3 shares into, where is the amount? Just one second. Huh? Yeah. So, okay, it is not given. So we are assuming face value of the shares be 10. Okay, and the dividend will be 2 rupees. Okay, because face value is not given. Assumed. So dividend will be 10 ka 20%, that is 2 rupees. So for 3 shares into 2 will be 6 rupees will be the dividend amount. Okay. Okay, na 10 rupees the face value. You can take 1 also, you can take 100 also. Answer will come same. Nothing to worry. So 10 is the face value, 20% dividend, 2 rupees dividend. 1 GDR has 3 shares. So you get total dividend as 6 rupees. Okay, clear? And divided by the PO, that is 810 ka 90%. 98%. Plus 20% as growth rate. Okay. 65793.8 plus this is the growth rate. Okay. 810 is the price, 270 to 3, uska 98%. Okay. So that comes out to be how much have you calculated? 65793.8 this and plus 20%. Okay, so 0.2075 or you can say 20.76%. Okay, beta, that completes the chapter and that's finished from my side. I have already students given you the PPT. You can take that. Now it's all our pleasure that sir is with us. So please let's pass on the mic to for his very golden words. Please, sir.
Thank you, Sushant. Am I audible? Am I audible?
Yes, sir. Now you are audible, sir.
1 second. Audible? 1 second.
Yes, sir. Yes.
1 minute. The voice is clear?
Absolutely, sir.
Okay. Now, student, when during the session, I have seen one or two very. One was saying depreciation treatment. There are some doubt regarding depreciation because in terminal year, as per Income Tax Act, there are some provision that in case there is any short-term capital loss, then you have to ignore the depreciation. There is some kind of block of asset concept is there. Now, student, in this case, what happens? We consider both treatments. So don't worry. We consider from examination point of view, if you ignore the depreciation in terminal year, or you consider along with the short-term capital loss, both will be awarded marks. So don't worry about the same. Unless and until there any clear-cut assumption regarding block of asset has been given to you. Okay. So because it is a financial paper, it is not an income tax paper, so you're not supposed to be very well versed with the concept of income tax. You are just supposed to just with the basis of the income tax. Now there was you were discussing Sushant regarding the computation of cube root, square root or like cube root. If their examination comes, then it is a problem for the student. But you have made to know the student how you compute on the calculator. But student, in this regard, please note that in examination, if you face any this kind of a problem, so don't worry, because if you leave the question unanswered after this step, then you will be awarded full marks because you are not supposed to, because you are not allowed to use scientific calculator. Of course, Sushant must have discussed with you the logic, but and even some coaching centers guys also share some their views how we calculate exponential value, etc. But from examination point of view, it is always supposed that you are not allowed to use a scientific calculator. So that's why with the ordinary calculator, up to what point you can make the calculation, you are supposed to do it. After that, you can leave it. You will awarded marks. No marks will be the same. Because it has happened in the earlier exam also somewhere in around November 2010 examination. I remember in the old scheme MAFA used to be paper. There we have also faced the same problem. So there we have to compute some value raised to power 1 by 3 or 1 by 5. It may I not recall. So after that we said okay, now students are supposed to not to write the answer. They will be awarded, but the previous step should be correct one. Okay, so there will be no reduction of the marks. So don't lose your confidence on that account. Now, one student Harshal has suggested a very good, made very good suggestion that there's a compilation of all assignment question and answers on forex and international financial management. Harshal, your session is very good. I will try that not only this compilation for only these two topics, rather the compilation for the all assignment questions will be made at one place. So, of course, we will work on this. And so far, theoretical questions, as Sushant sir has told you in the class, some topics are important from the theoretical point of view. But please remember, students, the paper setter's reason cannot be curtailed. So he can also frame a question from theoretical concepts also, but that happens rarely in very say 1 in say 5 examination. But you should be thorough with the concept, because ultimately if you are thorough with the concept, then you can attempt. Because ultimately what he does, he does set the question based on the theoretical concept. If you are well versed, you follow the steps, you will get the answer. So student, you have to worry about, but of course, theoretical aspect is important. And now with this, your main portion of forex related topics have been come to an end. Now in the next class, we shall take up the topic of interest rate management, and CA Dibas Gupta will take up the session. Thank you, Sushant, for sparing your precious time and delivering the taking deliberation on this topic to the students and make in a very crystal clear manner. So, students, whatever you have learned in the class, please revise the same. And as Sushant, just share your screen and share our email ID as well as phone number, please.
Yes, sir. I'll do that.
Now our email ID SFM-final, all in the small letters, at ICI.in. Okay, and my contact number is 0120 3045 956. Okay, students. So just revise and if you have any doubt, please contact us. Okay, have a nice day.
Thank
Okay,
you, sir.
Sushant. Thanks, sir.
Thank you, sir. Thank you.